Most traders don't fail because they lack intelligence. They don't fail because they lack indicators, strategies, or information. They fail because they are trying to trade someone else's system with their own psychology. And that mismatch quietly destroys them. You see, the market doesn't care how hard you studied. It doesn't care how many YouTube videos you watched. It doesn't care how confident you felt before clicking buy. The market only reflects one thing back to you: who you are when money is at risk. That's the truth most traders avoid. They hop from strategy to strategy, blaming entries, exits, timeframes, indicators, anything except the real source of inconsistency. They believe the next setup will finally remove uncertainty, eliminate fear, and give them confidence. But no strategy can do that, because the problem was never the strategy. The problem was trying to force a system to work that doesn't fit your beliefs, your temperament, or your relationship with risk. A strategy is just a set of rules. A system is how you execute those rules under pressure. And until your system fits you, every strategy you touch will eventually fail. Most traders never realize that the market is not testing their strategy, it is testing their self-concept. Every decision you make under risk exposes what you believe about yourself, about money, about control, and about uncertainty. When a strategy ignores who you are, it doesn't slowly fail, it creates internal conflict, and that conflict leaks into every trade you place. You might think trading is about finding the right setup, the right indicator, the right confirmation. But the truth is simpler and harder to accept. The market does not reward intelligence, effort, or desire. It rewards alignment. Alignment between your beliefs and your behavior. Alignment between your expectations and the reality of uncertainty. Alignment between what your system demands and what your mind can actually tolerate. Every strategy has psychological requirements. Some require patience. Some require speed. Some demand sitting through drawdowns. Some demand instant decision-making with incomplete information. None of these requirements are wrong. But pretending you can meet them when you can't is where most traders break themselves. If you are naturally cautious and you try to trade fast, aggressive strategies, you will hesitate. That hesitation will cause late entries. Late entries create stress. Stress leads to early exits. Early exits destroy expectancy. And then you conclude the strategy doesn't work. But what really didn't work was forcing your personality into an environment it was never built for. The market doesn't care about your intentions. It doesn't adjust itself to make you comfortable. It simply offers opportunities and reflects your response back to you. If you feel anxiety, frustration, or urgency while trading, that feeling is information. It's telling you something about the mismatch between your internal world and the structure you're trying to operate within. Most traders copy strategies without copying the psychological framework that makes those strategies executable. They see the entries and exits, but they don't see the emotional tolerance behind them. They don't see how much uncertainty the trader can sit with. They don't see how many losses the trader expects before a win. They don't see the deep acceptance of randomness that allows consistency to emerge. Instead, they assume if they follow the same rules, they'll get the same results. But rules alone do not produce consistency. Beliefs do. If you believe a loss means you are wrong, you will react emotionally to losing trades. If you believe missing a trade means missing money, you will chase price. If you believe you must always be in the market to succeed, you will overtrade. These beliefs don't disappear just because you adopted a new strategy. They express themselves through your execution. That's why two traders can trade the exact same system and get completely different results. One executes calmly, accepting losses as part of the distribution. The other tightens stops, skips trades, doubles size, or exits early. Same strategy, different outcomes. The difference is not skill, it's belief alignment. A strategy that fits you feels emotionally neutral. It does not trigger urgency. It does not demand that you override your instincts. It does not require constant self-control. When a system fits, discipline feels effortless because you're not fighting yourself. You're simply acting in accordance with what already feels natural. Most traders confuse discomfort with growth. They believe if trading feels uncomfortable, it must be working. But constant emotional discomfort is not growth, it's resistance. True growth in trading comes from expanding awareness, not from forcing behavior that violates your core beliefs. You cannot build consistency on internal contradiction. If your system requires holding trades overnight, but you cannot sleep with open risk, that system will never work for you. You might try to adapt. You might try to toughen up. But every night you'll feel tension. That tension will influence your decisions. Eventually, you'll break your rules, not because you're weak, but because the system ignored who you are. The market doesn't reward suffering, it rewards clarity. Clarity comes from knowing your limits and designing within them, not around them, not against them, within them. Most traders never take the time to understand their own psychological boundaries. They don't ask themselves how much uncertainty they can tolerate. They don't know how many losses in a row they can experience without changing behavior. They don't know how much time they can sit without a trade before forcing one. So they borrow strategies built for someone else's nervous system. And then they wonder why they feel exhausted, confused, and inconsistent. A strategy that ignores who you are turns trading into a constant internal argument. One part of you wants to follow the rules. Another part wants relief from discomfort. Eventually, the part seeking relief wins, and that's when discipline collapses. The market is not emotional. You are. And there is nothing wrong with that. The mistake is pretending you aren't. Successful traders do not eliminate emotion. They design systems that don't provoke destructive emotion. They structure risk, timing, and frequency in a way that keeps their mind clear. They don't ask themselves to be fearless. They ask themselves to be honest. Honest about what they can handle. Honest about what they can repeat. Honest about what they can trust. If you constantly feel the urge to interfere with trades, that is not a discipline problem. It's a design problem. The system is asking more of you than your current beliefs can give. And here's the most important truth. The market does not require you to change who you are to succeed. It requires you to stop pretending to be someone else. There is room in the market for many personalities: short-term thinkers, long-term thinkers, aggressive traders, conservative traders. The only personalities that fail are the ones that try to operate in environments they don't belong in. When a strategy fits you, execution becomes boring, repetitive, almost uninteresting. That's a sign of alignment. Excitement in trading usually means you are emotionally invested in the outcome. Emotional investment creates attachment. Attachment creates fear. Fear distorts perception. A fitting system removes the need for hope. You don't hope the trade works. You don't fear that it won't. You simply execute because the outcome no longer defines you. And that is the point where consistency becomes possible. Not because you found the perfect strategy, but because you finally stopped ignoring who you are. Most traders believe their problem is entries. They spend endless hours refining setups, stacking indicators, searching for confirmation, adjusting timeframes, and optimizing parameters. They believe that if they can just find the perfect entry, everything else will fall into place. But the market doesn't punish bad entries nearly as harshly as it punishes poor risk management. And that's why most trading systems fail long before the strategy itself ever has a chance to work. A real trading system is not designed to predict the market. It is designed to protect your ability to think clearly while participating in uncertainty. That protection comes from risk, not setups. Setups are easy to learn. Risk acceptance is not. You can copy a setup in a few minutes. You can memorize rules, watch examples, and replicate entries. But risk reveals who you are when money is on the line. It exposes your fear of loss, your attachment to outcomes, and your need for certainty. And if your system is built around setups instead of risk, those emotional pressures will eventually overpower your rules. The market is a random distribution of outcomes. Even the best setups lose. That is not a flaw, it is the nature of probability. Yet most traders subconsciously expect their setups to protect them from loss. When that expectation is violated, they react. They move stops, hesitate, revenge trade, or abandon the system entirely. This is not because they are undisciplined. It's because their system never taught them how to lose properly. A system built around risk starts with a simple question: how much am I willing to lose and remain emotionally neutral? Not how much I want to make, not how accurate the setup is, but how much loss I can experience without changing my behavior. That number defines everything. If your position size creates anxiety, your perception narrows. You stop seeing the market objectively. You see threat instead of information. Once that happens, execution becomes reactive. You are no longer following a system, you are trying to escape discomfort. Most traders size positions based on desire, not tolerance. They trade too large because they want results faster. But speed magnifies emotion, and emotion destroys consistency. The market doesn't reward urgency. It punishes it. A risk-based system accepts loss in advance. The loss is not a surprise. It is not personal. It is simply the cost of doing business. When you truly accept the risk before entering a trade, the outcome loses its emotional charge. Win or lose, you remain stable. This is the foundation of professional thinking. Professionals don't ask, will this trade work? They ask, if this trade doesn't work, will I still execute the next one the same way? That question shifts focus from outcome to process. And process is where consistency lies. Setups are meaningless without controlled risk because probability only works over a series of trades. If you emotionally sabotage even a small portion of that series, the edge collapses. Cutting winners short, letting losers run, skipping trades after losses, these behaviors don't come from bad analysis. They come from unmanaged risk. A system built around risk defines when you stop trading. It defines how many losses you are willing to take in a session. It defines when you walk away, not because the market told you to, but because your mental state did. This is critical. Once your emotional state deteriorates, every decision after that point is compromised. A risk-based system prevents that spiral by placing limits on exposure, not just financial exposure, but psychological exposure. Most traders think discipline is about forcing themselves to follow rules. In reality, discipline is a byproduct of good system design. When your risk is small enough to be irrelevant emotionally, discipline becomes effortless. You don't need willpower. You don't need motivation. You simply execute. If you constantly struggle with discipline, it's not a character flaw. It's feedback. The market is telling you that your risk is too large for your current beliefs. A real trading system evolves with you. As your confidence grows through experience, not hope, your tolerance for risk may expand. But that expansion must be earned. It cannot be forced. Forcing risk creates pressure. Pressure creates mistakes. Mistakes reinforce fear. This cycle destroys traders quietly. A system built around setups encourages prediction. A system built around risk encourages participation. Participation is neutral. Prediction is emotional. The moment you need a trade to work, you've already lost objectivity. Risk-first thinking removes the need to be right. You don't need to know what the market will do next. You only need to know what you will do if it doesn't do what you expect. That clarity is power. When your system is anchored in risk, losses stop being threatening. They become routine. They become data points in a larger distribution. And when losses no longer hurt emotionally, you stop avoiding them. When you stop avoiding them, you stop interfering with your system. That's when probability finally has room to express itself. A trader who manages risk properly can survive long losing streaks without changing behavior. A trader who doesn't will abandon a profitable system at the worst possible time. The difference is not courage, it's preparation. A real system does not try to eliminate loss. It embraces it as necessary, it plans for it, it respects it, and in doing so, it removes its power. Setups come and go, markets change, conditions evolve, but risk acceptance is timeless. If you build your system around risk, you can adapt to any market environment without losing yourself. That is the real edge, not a secret indicator, not a perfect setup, but a system that protects your mind first and lets profits take care of themselves. Most traders understand probability intellectually, but very few allow it to work for them in practice. They say they know no single trade matters, yet they treat every trade as if it defines their future. This contradiction is the quiet killer of consistency. Probability only works when your system allows you to stay present, neutral, and consistent over a large enough sample size. And that only happens when the system fits you. The market does not pay you for being right. It pays you for executing an edge repeatedly without distortion. That sounds simple, but it requires something most traders never develop: emotional compatibility with uncertainty. If your system creates stress, urgency, or fear, you will eventually interfere. And the moment you interfere, probability stops working. Probability is impersonal. It doesn't care about your last trade. It doesn't reward hope. It doesn't punish fear. It simply expresses itself over time if you let it. But letting it work requires trust. Trust requires understanding. And understanding only comes from alignment between who you are and how you trade. A system that fits you removes the need to predict. You are no longer trying to guess what will happen next. You are simply participating in a process with a known statistical edge. When you accept that outcomes are random in the short term, you stop reacting emotionally to individual trades. Each trade becomes just one event in a series. Most traders sabotage this process by constantly evaluating themselves trade by trade. A win makes them confident. A loss makes them doubt. A few losses in a row make them abandon the system altogether. This behavior has nothing to do with market conditions. It comes from a system that demands emotional resilience the trader does not yet have. Probability requires repetition. Repetition requires stability. Stability requires a system that does not overload your nervous system. If your position size is too large, every trade feels important. Importance creates pressure. Pressure distorts perception. You start seeing what you want to see instead of what is actually happening. You hesitate on valid trades and justify invalid ones. Over time, your results become random, not because the market is random, but because your execution is. A fitting system makes execution boring, and boring is powerful. Boring means predictable. Boring means repeatable. Boring means your emotional state remains unchanged regardless of outcome. When nothing inside you spikes after a win or collapses after a loss, you are finally in a position to let probability do its job. Most traders want excitement. They mistake emotional stimulation for opportunity. But excitement in trading is a sign that your identity is tied to the outcome. When your identity is on the line, objectivity disappears. You are no longer managing trades, you are managing self-image. A system that fits you removes ego from the process. It reduces decision-making in real time. It tells you when to enter, when to exit, and when to do nothing. And most importantly, it defines when to stop. These boundaries are not limitations. They are safeguards that protect consistency. Probability does not reward intensity. It rewards patience. When you truly understand that losses are not failures but expected outcomes within a distribution, you stop resisting them. Resistance creates tension. Tension creates mistakes. Acceptance creates flow. Flow allows repetition. The market will test you with streaks. Winning streaks that tempt you to increase risk prematurely. Losing streaks that tempt you to abandon the system. A system that fits you anticipates these moments. It has rules that prevent emotional escalation. It keeps you operating at a level where your behavior remains unchanged. This is where most traders fall apart. They believe confidence comes from winning. In reality, confidence comes from trust in process. And trust in process comes from experience executing the same system under many different conditions without emotional disruption. You cannot shortcut this. A system that fits you allows you to lose without needing to explain it. You don't analyze losses emotionally. You don't rewrite rules after a bad day. You don't look for validation from outside sources. You understand that short-term outcomes say nothing about long-term expectancy. That understanding creates calm. Calm creates consistency. Consistency allows probability to unfold. Over time, the edge reveals itself. Not dramatically, not perfectly, but steadily. The equity curve rises not because every trade is good, but because your behavior is stable. Most traders never reach this stage because they never stop fighting the market. They want certainty in an environment that cannot provide it. They want control where only probability exists. A fitting system ends that fight. You stop trying to force outcomes. You stop needing reassurance. You stop measuring success in individual moments. You measure it in adherence to process. This shift is subtle, but it changes everything. When probability is allowed to work, you no longer feel pressure to perform. You feel responsibility to execute. That responsibility is calm, focused, and grounded. There is no rush. There is no desperation. Just participation. And that is the paradox of trading. The less you try to control the market, the more consistent your results become. A system that fits you does not guarantee profits. Nothing can. But it gives you the only thing that makes profits possible, the ability to stay in the game long enough, consistently enough, and clearly enough for probability to express itself. That is not luck. That is alignment. And alignment is what turns uncertainty into opportunity over time. In trading, success is never about finding the perfect setup or strategy. It is about building a system that fits who you are, your beliefs, your emotional tolerance, and your capacity for risk. When your system aligns with your psychology, fear disappears, discipline becomes effortless, and probability is allowed to work over time. The market rewards consistency, not perfection, and that consistency only comes when your rules, your behavior, and your mindset are in harmony. Mastery begins not with the market, but with understanding yourself.